Imagine opening your eyes in the morning, reaching for your mobile device, and reviewing your bank account as you typically do. At first glance, everything appears standard. Your available funds are present, your incoming payments processed successfully. Nothing appears unusual. However, beneath the surface, something has shifted, and the majority of individuals are completely unaware this is occurring. Because beginning in 2026, a specific threshold, $10,000, may quietly decide whether your banking activity becomes marked, examined, or scrutinized. And here's the aspect that's surprising numerous individuals. It's no longer exclusively about significant transactions. It's about sequences, frequency, and how your funds transfer, even when every cent belongs to you, even when you've committed absolutely zero violations. For countless retired individuals living on set incomes, handling savings prudently, assisting relatives, or simply transferring funds across accounts, typical conduct can unexpectedly appear questionable to a framework that lacks familiarity with you, lacks knowledge of your background, and lacks consideration for purpose. And after you're within that scope, what follows next can vary from a basic notice to something significantly more challenging. So the actual question is, what truly shifted and why are numerous older adults vulnerable without recognizing it? Hi, I'm Sophia, and in this presentation, I'm going to guide you through precisely what this $10,000 threshold truly represents approaching 2026. What's genuinely evolving beneath the surface and why it's impacting older adults more than nearly everyone else presently. We're going to examine this in an understandable, useful manner. No technical language, no scare strategies, simply what you must understand to safeguard yourself and maintain authority over your finances. I'll additionally present you authentic scenarios that appear entirely typical on the exterior, but may activate scrutiny under the existing framework. And critically, what straightforward actions you can implement to prevent issues before they commence. Because after you comprehend how this operates, the complete situation becomes significantly more controllable. But there's one illustration particularly that makes all of this extremely tangible, and it begins with someone similar to you. Let me present you to Patricia. She's 71 years young, a former educator who dedicated over 3 decades in education. She maintains a peaceful, organized lifestyle, and like numerous retired individuals, she handles her personal finances attentively. Each month, her government retirement benefit is transferred into her account. Periodically, she moves funds from her reserves to address bigger costs, a healthcare invoice, a property fix, a trip to visit her descendants. Nothing uncommon, nothing questionable, simply the kind of monetary routine countless older adults maintain every single day. She's never attempted to conceal funds, never overlooked obligations, never completed anything remotely improper. But here's when circumstances shift direction. Under the frameworks currently being implemented and broadened approaching 2026, Patricia's completely typical conduct could begin to appear irregular, not to an individual, but to a computerized framework trained to identify sequences. Because the framework doesn't recognize a former educator handling her reserves, it recognizes transfers, movements, frequency, and values. And when those sequences don't precisely correspond with what's documented officially, they may activate scrutiny. Not because something is incorrect, but because something doesn't flawlessly match. And this is precisely when numerous individuals become surprised. Because to comprehend why Patricia and countless similar to her could become within that scope, you must comprehend when this complete framework originated. This traces entirely back to 1970, when the nation passed legislation called the Bank Secrecy Act. During that period, the objective was direct. Provide the authorities a method to monitor significant monetary violations like fund cleaning, substance commerce, and obligation avoidance. As component of that legislation, financial institutions were obligated to document specific kinds of transactions, particularly any currency transfer or removal of $10,000 or above. That documentation is called a currency transaction report, and for generations, that $10,000 limit has remained precisely identical. But here's what the majority of individuals don't understand. That figure was established over 50 years previously. Corrected for economic changes, $10,000 during that era would be roughly comparable to around $80,000 presently. In different terms, what was previously regarded a significant uncommon transaction is currently something significantly more typical in regular monetary existence. Retirement withdrawals, property-associated costs, even specific kinds of reserve movements can readily achieve that amount without creating any actual concern. But the framework never corrected. The figure remained locked in history. And currently, as monetary conduct has expanded and developed, increasingly more typical individuals are approaching a limit that was never intended for today's circumstances, which creates an essential inquiry. If the regulation itself hasn't shifted, why does it unexpectedly seem like the vulnerability is growing? And the response to that inquiry begins with something the majority of individuals have never encountered. But it's one of the primary reasons accounts become marked presently. It's called structuring. Now, officially, structuring is quite straightforward. It's when someone purposefully separates a significant transaction into smaller values to prevent activating that $10,000 documentation obligation. For illustration, instead of transferring $15,000 all simultaneously, someone might transfer $9,000 presently, another $9,000 following, and maintain everything slightly below the limit. That sequence, even though each separate transfer is below $10,000, is regarded a warning signal. And in significant instances, it may genuinely be handled as a national violation. And when you learn that, it likely sounds logical. The concept is to identify individuals who are purposefully attempting to conceal funds. But here's when circumstances begin to become challenging, because the framework doesn't genuinely understand purpose. It doesn't understand why you completed those transfers. It exclusively recognizes the sequence, and that's precisely when older adults, more than nearly any different category, begin to encounter difficulty without understanding it. Many elderly Americans didn't mature in a society of electronic banking and computerized monitoring. Numerous still favor currency. Some maintain funds at residence, others complete smaller, more regular transfers simply because that's how they've consistently handled their finances. It seems more protected, more managed, more recognizable. But to a computerized surveillance framework, that identical conduct can appear nearly matching to someone attempting to prevent documentation regulations, and that's the separation. What seems typical to you can appear questionable to a framework that's exclusively prepared to identify sequences, not comprehend individuals. There have been actual situations when individuals, entirely law-following, had their accounts marked simply because their transfer practices didn't match what the framework anticipated. No wrongful purpose, no concealed revenue, simply a discrepancy between human conduct and machine understanding. And after that signal is activated, it may initiate a sequence response that the majority of individuals are unprepared for, because this doesn't simply conclude at a documentation being submitted somewhere in the foundation. In certain instances, it intensifies. Accounts may be examined more thoroughly. Transactions may be scrutinized, and in more significant situations, particularly when structuring is suspected, assets may genuinely be restricted while circumstances are examined. There have been verified instances when individuals had tens of thousands of funds tied unavailable for months, sometimes extended, simply because their transaction sequences create concerns. And what makes this particularly more challenging is how the procedure operates after that occurs. In specific situations, the responsibility transfers to you to demonstrate that your personal funds are valid, not the alternative direction. That indicates collecting documentation, clarifying transactions, sometimes even obtaining professional assistance simply to recover availability to assets that were yours initially. For someone existing on a set revenue, that kind of interference isn't simply bothersome. It may be monetarily catastrophic. Now, to be specific, this is not what occurs to the majority of individuals. Countless transactions are documented every single year, and the overwhelming majority never result to any continuation whatsoever. But the explanation this matters, particularly currently, is because the framework that determines which instances receive scrutiny is evolving. And that's the component that brings us straight into what's occurring following. And why 2026 is such a critical moment. And this is when circumstances transition in a method that the majority of individuals haven't completely understood yet. Because approaching 2026, the primary modification isn't the $10,000 regulation itself. It's how that regulation is being implemented. For generations, these documentations primarily existed in enormous databases with restricted capability to examine them in a significant immediate method. There was simply excessive information and insufficient innovation to associate all the elements. But that's no extended the situation. The tax authority currently has considerably more resources, more sophisticated frameworks, and significantly more advanced instruments intended to examine monetary information at magnitude. What previously demanded manual examination may currently be completed mechanically. Sequences may be identified immediately. Transactions may be compared against your documented revenue, your obligation submissions, and your monetary background without any individual ever reviewing it initially. So what does that genuinely indicate in simple terms? It indicates the framework is no extended simply gathering details. It's understanding it. If funds transfer into your account, the framework may inquire, does this correspond what this individual reports to receive? If there are repeated transfers, it may inquire, does this sequence resemble identified vulnerability conduct? If there are discrepancies, even minor ones, it may mark them for additional examination. And all of this may occur silently in the foundation without you ever understanding it's occurring. The regulation didn't shift, but the application did. And that one transition is what's making the $10,000 limit more applicable and in certain instances more hazardous than it has previously been. Now, this impacts everyone to a certain extent. But older adults are in a distinctively exposed situation within this framework. And the explanation comes down to how retirement finances genuinely operate in actual existence versus how they appear officially. During your employment years, revenue tends to be foreseeable. You obtain a salary, obligations are removed, everything is relatively direct. But in retirement, that organization shifts entirely. Revenue begins arriving from various origins: government benefits, retirement plans, retirement funds, reserves, and it doesn't consistently follow a neat, uniform sequence. One month might be peaceful, the following might include a bigger removal, a movement, or a single transfer. To you, it creates complete logic. But to a computerized framework searching for uniformity, those differences may be noticeable. Consider retirement withdrawals for illustration. If you remove funds from a retirement fund or a retirement plan, particularly for mandatory minimum withdrawals, those values may readily surpass $10,000 depending on the magnitude of your reserves. That transaction becomes documented, and if your obligation documentation doesn't precisely represent or clarify that transfer of funds in a method the framework may rapidly correspond, it may create inquiries, not because anything is incorrect, but because the framework is intended to mark what it doesn't immediately comprehend. The identical circumstance applies to different typical situations older adults encounter: transferring funds across accounts, combining assets, or addressing significant irregular costs. These are typical monetary choices, but they don't consistently appear typical through the perspective of computerized examination, and that's genuinely the fundamental matter. It's not that older adults are completing anything incorrect. It's that their monetary existences are more intricate, more changeable, and more probable to generate sequences that don't precisely match with what the framework anticipates, which is precisely why specific regular situations, circumstances numerous retired individuals complete without a secondary consideration are becoming some of the most typical activators for scrutiny. And after you recognize what those situations are, you begin to understand simply how straightforward it is to unintentionally enter into one of these sequences without even understanding it. So, let's examine the situations that matter primarily because these are the precise moments when entirely typical monetary conduct may begin to appear improper from the exterior, even when everything is flawlessly valid. The initial one is retirement withdrawals. This is one of the most typical activators, and nearly nobody considers twice about it. You've dedicated generations building your reserves, and currently you're obtaining from those accounts to exist your existence. Maybe it's a mandatory minimum withdrawal. Maybe it's a bigger removal to address a primary cost like property fixes or healthcare invoices. Either method, it's your funds. But if that withdrawal exceeds specific limits, particularly around or beyond $10,000, it becomes documented. And if the frequency or value doesn't precisely match with what's represented on your obligation documentation, even briefly, it may create a signal, not a determination, simply an inquiry. But that inquiry may be adequate to position your account on the scope. The secondary situation is providing funds to relatives. This is something numerous older adults take satisfaction in: assisting offspring, supporting descendants, participating to primary existence moments like learning or purchasing a residence. And in the majority of instances, it's entirely permitted. But the method those contributions are provided matters more than the majority of individuals understand. Significant movements, repeated movements, or currency-oriented contributions may all generate sequences that appear irregular if they aren't precisely verified. The framework doesn't recognize kindness. It recognizes transfer of assets, and if those transfers aren't straightforward to understand, they may activate scrutiny, particularly when various transactions happen within a brief duration of time. The third is primary existence changes, like disposing of a residence or obtaining an estate. These are significant monetary moments, frequently including significant combined amounts that transfer through your accounts all simultaneously. Maybe you're reducing, moving, or managing a relative property. The figures included may be considerable, sometimes significantly beyond that $10,000 limit. And while these transactions are completely valid, they may generate brief increases in your monetary conduct that be noticeable sharply compared to your typical sequences. Again, it's not that anything is incorrect, it's that the framework is intended to recognize when something shifts unexpectedly. And the fourth situation is one that remains beneath awareness for many individuals: currency-oriented practices or casual monetary arrangements. This includes circumstances like disposing of individual possessions, gathering property payments, or even assisting a relative by briefly maintaining funds and subsequently moving it afterward. These situations frequently include currency or various smaller transactions. And when those transactions begin to establish sequences, particularly sequences that resemble structuring, they may create concerns. What seems like straightforward regular fund handling may appear extremely different when it's reduced to information elements on a display. Now here's when it becomes particularly essential to comprehend what occurs following. Because after a transaction or sequence is marked, it doesn't mechanically indicate there's a difficulty, but it does indicate your details enters a framework intended to examine more thoroughly. When a financial institution submits a documentation, whether it's connected to a significant transaction or a questionable sequence, that details is transmitted to a national database, handled by the Treasury Department. From there, it becomes reachable to organizations like the tax authority, which implement their personal instruments to examine whether anything requires additional scrutiny. In numerous instances, nothing occurs whatsoever. The documentation remains their component of a significantly bigger information collection never responded upon. But if something is noticeable, if there's a discrepancy, a sequence, or an inquiry that cannot be readily addressed by the framework, that's when it may transfer to the following action. And that action is typically communication. It might begin with a notice requesting explanation about particular transactions. Direct but still concerning if you're not anticipating it. In different instances, it may intensify into a structured review when your monetary documentation are examined more thoroughly over a duration of time. And in more significant situations, especially when sequences resemble structuring or unexplained currency movement, the results may become more prompt. Accounts may be limited. Assets may be briefly restricted. And in uncommon but extremely actual instances, official procedures may begin that obligate you to actively demonstrate where your funds originated from and why it transferred the method it completed. That's the component that surprises individuals because at that moment, it's no extended simply about comprehending the regulations. It's about addressing them under tension. Now, before this begins to sound difficult, there's something essential you must understand. Because while all of this is actual and the vulnerabilities are growing, there's another aspect to this that the majority of individuals never learn, and it modifies how you should consider everything we've simply addressed. Now, here's the component that nearly never becomes clarified, but it entirely modifies how you should consider all of this. The overwhelming majority of these documentations never result to anything. Countless upon countless transactions are marked, documented, and preserved every single year, and the majority of them are never examined by a human individual. No notice, no review, no continuation, nothing. And that's essential because it indicates the framework isn't intended to pursue every retired individual who transfers or transfers funds in a somewhat irregular method. It simply wouldn't be achievable. But, and this is the fundamental transition, the framework is becoming superior at reducing its emphasis. It's no extended about quantity, it's about accuracy. With more sophisticated instruments, superior information correspondence, and computerized examination, the tax authority doesn't require to review everything. It simply requires to recognize the sequences that be noticeable, the primarily. And that's why the vulnerability, while still comparatively minimal on a separate amount, is growing in an extremely particular method. It's becoming more focused, more careful, more reliant on whether your monetary conduct is straightforward to comprehend or confusing when observed through information exclusively. So the actual objective here isn't to prevent the framework completely. That's not practical. The objective is to guarantee that if your monetary conduct is previously examined, it creates logic promptly. No uncertainty, no confusion, no unanswered inquiries. And this is when circumstances transition from consciousness to authority, because there are a couple straightforward, useful actions that create a tremendous variation. And the initial one is additionally the most influential. Maintain precise, structured documentation of your monetary conduct, not simply your regular statements, but anything connected to bigger or less regular transactions. If you dispose of your residence, maintain the completion records. If you obtain an estate, maintain the documentation that presents where that funds originated from. If you obtain a withdrawal from a retirement fund, preserve the statements that clarify it. And if you provide funds to a relative, document it. Date, value, and objective. Because if an inquiry previously arises, the variation between a rapid resolution and an extended matter frequently comes down to one circumstance: verification. The framework may mark a transaction, but it cannot dispute with a precise documentation path. The secondary action is operating with the appropriate kind of expert. And this is particularly essential for older adults because retirement finances are not as straightforward as they previously were. A certified obligation expert, someone who comprehends retirement revenue, withdrawals, and documentation obligations, may assist you organize circumstances in a method that is both adherent and straightforward to clarify. They may guarantee your obligation submissions represent what's genuinely occurring in your accounts, so there are zero separations. They may additionally guide you on circumstances like contribution documentation, significant movements, and frequency. Minor corrections that may prevent confusion afterward. This isn't about completing anything differently in a primary method. It's about guaranteeing everything matches precisely across the platform. And the third action might sound opposite initially, but it's critical. Prevent attempting to remain beneath awareness by separating transactions. If you require to transfer a significant value of funds, complete it precisely in one transaction and verify it appropriately, because various smaller transfers that drop slightly below $10,000 may appear significantly more questionable than an individual bigger one that is precisely clarified. This is one of the most typical errors individuals complete, not from improper purpose, but from carefulness. They believe they're being careful, when in reality, they're generating a sequence that obtains more scrutiny. Openness, when it's supported by verification, is consistently the more protected direction. Now, there are a couple more actions that become similarly essential after you comprehend how this framework genuinely operates, particularly when it relates to your protections, your relatives, and situations that the majority of individuals never consider twice about until they become a difficulty. The following protection comes down to something many individuals don't consider about until it's delayed, and that's comprehending your protections and how to address if you're previously communicated. Because if you obtain a notice or a notification, the most harmful circumstance you may complete is worry or disregard it. These situations are nearly consistently controllable when managed appropriately. You possess the protection to comprehend why you're being communicated. You possess the protection to address with verification, and critically, you possess the protection to counsel. That indicates you don't require to determine it independently. A certified obligation expert or legal professional may participate, communicate on your representation, and guarantee everything is managed appropriately. In numerous instances, what appears significant initially is addressed with precise documentation and a straightforward clarification, but frequency matters. Addressing promptly, peacefully, and appropriately may prevent a minor matter from becoming something significantly bigger. Another action that becomes extremely essential, particularly for older adults, is guaranteeing that any monetary assistance across relatives is managed in a method that's straightforward to monitor and clarify. This is when considerable confusion may occur without anyone understanding it. Maybe a mature offspring is assisting address costs by transferring funds into your account. Maybe you're assisting a descendant and transmitting assets consistently. On an individual amount, it's straightforward and kind. But from the framework's viewpoint, repeated transfers, particularly in currency or irregular values, may begin to establish sequences that don't promptly create logic. And again, the framework doesn't comprehend connections. It comprehends information. So the superior method to manage this is to generate precision. Implement approaches that create a documentation like payments or technological movements and maintain records about what those movements are for. It doesn't require to be challenging, it simply requires to be precise. And subsequently, there's something that frequently remains unexpressed, but it performs an extremely actual function in all of this. Existence modifications. As individuals become elderly, handling finances may become more intricate. Not necessarily because the funds are challenging, but because the frameworks around it are. Some older adults begin to depend on relatives to assist handle accounts, address invoices, or transfer funds. Others establish mechanical movements or combined availability without completely revisiting how everything is organized over duration. And in situations when retention or mental precision begins to reduce, even somewhat, it becomes simpler for transactions to occur without a complete comprehension of how they might seem from the exterior. That's not a shortcoming. It's a circumstance numerous relatives encounter, but it does enhance the significance of possessing the appropriate safeguards positioned. If you're assisting a guardian or relative handle their finances, guarantee everything is established appropriately. That indicates possessing official permission, like a legal document, so there's zero inquiry about who is handling the account and why. It additionally indicates maintaining thorough documentation of anything you complete on their representation. Every movement, every settlement, every transfer should be straightforward to clarify if required. Not because you anticipate a difficulty, but because if an inquiry previously develops, you're arranged to respond it promptly and precisely. That amount of structure safeguards both the individual handling the funds and the individual whose funds it is. Because at the conclusion of the day, the majority of the matters that emerge from this framework aren't produced by violations. They're produced by confusion, separations across what genuinely occurred and what may be precisely presented. And when you eliminate that separation, you considerably decrease the possibilities of previously encountering a difficulty initially. But there's one more section that merits scrutiny because it's not simply about how the framework recognizes you. It's additionally about how improper performers may exploit it and how rapidly a typical situation may transform into something significantly more significant if you're not conscious of what to search for. One of the most disregarded vulnerabilities in all of this has nothing to complete with the tax authority straight, but it may still involve you into the identical kind of difficulty, and that's monetary deceptions. Because presently, there are wrongdoers particularly focusing older adults with directions that sound straightforward, pressing, and peculiarly particular. They might request you to remove currency, transfer funds in smaller values, or transmit assets in a method that prevents scrutiny. They'll frequently generate a perception of tension, informing you it's duration critical, private, or connected to something essential like a relative crisis, an official matter, or even a claimed authority demand. And in the moment, it may seem persuasive. But here's the concealed risk. Those precise directions, transferring funds in smaller values, responding rapidly, preventing typical channels, may generate sequences that appear precisely like structuring or questionable conduct. So, not exclusively may these deceptions obtain your funds, they may additionally create behind a monetary path that creates warning signals in the framework. From the exterior, it may appear like you were purposefully attempting to transfer funds in a specific method when in circumstances you were being controlled. And that's what makes this so significant, because after those sequences exist, they don't arrive with situation. They don't clarify that you were under tension or deceived. They simply present what occurred. That's why one of the most essential practices you may establish is this. Whenever you're requested to transfer funds in a method that seems irregular, hurried, or confidential, stop. Obtain an action backward. Communicate to someone you rely on before completing anything, a relative, a monetary consultant, even your financial institution. Because one discussion may prevent a situation that's not exclusively monetarily harmful, but extremely challenging to resolve afterward. And beyond all the regulations, the documentation, and the frameworks, there's a more profound matter here that many individuals experience, but don't consistently express aloud. It's that perception of being observed, of possessing your monetary existence supervised after generations of completing everything the appropriate method. For numerous older adults, that experience isn't simply irritating, it seems individual. You operated, you preserved, you observed the regulations, and currently it may appear like typical conduct is being observed with doubt, and that pressure is actual. On one aspect, there's a requirement to prevent significant monetary wrongdoing. On the different, there's an extremely human wish for confidentiality, freedom, and authority over your personal funds. That equilibrium isn't flawless, and it likely never will be, but comprehending how the framework operates provides you something essential. It provides you authority within that framework. Because after you understand what activates scrutiny, after you comprehend how your monetary conduct is being understood, you're no extended uncertain. You're completing educated choices. You're verifying what matters. You're preventing sequences that may be misunderstood. And that transitions the complete experience from doubt to precision, because this isn't about modifying your existence or being concerned to implement your personal funds. It's about guaranteeing that the method you handle it is as precise officially as it is in circumstances. And when you complete that, the majority of the vulnerability we've discussed simply diminishes into the foundation when it belongs. Now, reviewing forward, there's one concluding component you require to comprehend, because what's occurring currently isn't a single modification. It's component of a significantly bigger transition that's still developing, and it's going to establish how monetary frameworks operate for years approaching. As we review forward, it's essential to comprehend that what's occurring presently isn't brief. It's component of an extended duration transition in how monetary frameworks function. The transfer toward more information, more mechanization, and more immediate examination isn't reducing. If anything, it's quickening. Every year, the innovation becomes more sophisticated, the frameworks become more associated, and the capability to identify sequences becomes more accurate. And that's accurate irrespective of governance, leaderships, or regulation discussions. The instruments are already present, and they're exclusively becoming superior at completing what they were intended to complete. Examine monetary conduct at magnitude. Now, that doesn't indicate the regulations themselves won't develop. There will persist to be discussions about limits, confidentiality, application, and equity. Some recommendations will transfer ahead, different will be reduced backward, similarly like we've witnessed previously. But the comprehensive path is precise. Monetary conduct is becoming more visible to the frameworks that supervise it, and that indicates the practices you establish currently, maintaining documentation, remaining structured, comprehending how your funds transfers, aren't simply beneficial in the brief duration. They're becoming critical components of handling your finances in the contemporary society. But here's the component that matters primarily. None of this eliminates your capability to handle your funds assuredly and protected. You are not helpless in this framework. In reality, after you comprehend how it operates, you're in a significantly more powerful situation than the majority of individuals, because the vulnerabilities we've discussed don't originate from completing typical circumstances. They originate from completing typical circumstances without precise verification or consciousness of how they seem. And that's a difficulty you may address. You may maintain documentation that inform the complete account. You may operate with experts who guarantee everything matches appropriately. You may prevent sequences that generate confusion. And you may remain educated as these frameworks persist to develop. Those are straightforward, useful actions, but they create an enormous variation. They transform something that seems doubtful into something that's entirely controllable. At the conclusion of the day, you've dedicated your existence building what you possess. You've received the protection to implement it, appreciate it, and distribute it without needless pressure or concern. And the objective here isn't to create you anxious, it's to guarantee you're arranged. Because when you comprehend the regulations, when you understand what to observe for, and when you possess a precise strategy positioned, you may transfer ahead with assurance, understanding precisely when you exist. If this assisted explain circumstances for you, regard distributing it with someone who might require to learn it. Because many individuals are still unaware of how these modifications may impact them. And if you possess inquiries or particular situations you'd prefer addressed, inform me. There's much more to investigate when it relates to retirement obligations and safeguarding your monetary destiny.